Property plant, explain how to enterprise accounts for items of property, plant and equipment. We will discuss only the property, plant and equipment. We will not discuss the mineral rights or regenerative natural resources like oil and gas or those resources. We are not going to talk about it. So when you go to drilling mines or drilling plants, now we have onshore and offshore. Onshore meaning we have a drilling platform in the land. So that is a land now. So if that is a land, if it's a free land, that will fall under A16. But with the natural reserves and regenerative resources, that falls under another scope. So IFRS 6, accounting for oil and gas. We will talk in that. Anyway, in this scope, we have not included that standard anyway. So, or mineral exploration for and extraction of minerals, oil, natural gas, and similar non-regenerative, non-regenerative resources. Separable property, plant and equipment. Property, plant and equipment are tangible assets to be used during more than one period and that are held for use in the production or supply of goods or services for rental to others or for administrative purposes. These are, in other words, examples. Land, building, machinery, motor vehicle, etc., etc., kida. Because he is the hero there. With the maybe my eyes are big. He is wearing tie, and then for me this is big. Yes. Cost is the fair value of the consideration given to acquire the asset. How much you had to pay for as a consideration in receiving that asset. Depreciable amount, we talked about it. Residual value, we talked about it. The period of time, that is useful economic lifetime, and there are other methods in calculating depreciation. That's what it is discussed. Depreciation, fair value, the amount for which the asset could be exchanged between knowledgeable willing parties in an arm's length transaction. Yes? Carrying amount, the amount for which the asset is recognized after deducting accumulated. Actually, there is something missing here, which the amount for which the asset after is recognized for deducting accumulated depreciation and impairment losses. Please note that. Now, what is impairment now? What is impairment? Impairment. There is something called recoverable amount, something called carrying amount, and there is also something called value in use. There is something called fair value, less cost to sell. These terms we need to discuss. However, to keep it very simple, the significant drop in the value compared to the carrying amount is what the impairment is. So, let's say your carrying amount is 1,000 and your the full market value is 600. Then this 400 is the impairment loss. I just forgot something related to revaluation. If you happen to reverse any impairment, any losses, as you understood, a permanent diminishing values cannot be reversed. The normal, if any special scenario like a fire, building is totally shut down, then then subsequently you cannot reverse that. Remember that also. So this 400 is what impairment is. Now This is, let's say, year 1. And year 2, I have another 200. So the total accumulated impairment is loss how much? 600. That's what we wanted to mean here. Accumulated depreciation and accumulated impairment losses is the amount by which an asset's carrying amount exceeds its recoverable amount. How I work out the recoverable amount? This no problem. This pen supports me. No problem. You know why Siraj gave me that pen? To help me boost my, the carrying amount, which is cost minus accumulated depreciation. And then we have something called recoverable amount. The recoverable amount is not a straightforward definition. We need to have a value in use or fair value less cost to sell. You need to work out and find out what you mean by this. What do you mean by value in use? Economic returns that will generate because of using the assets for the remaining useful life of the period. Meaning I have this table. From today, this table can be there for another 5 years. And using this table, I could generate every year $300. So, year 1, 300, year 2, 300, year 3, 300, year 4, 300, and year 5, 300. This is very theoretical number. This may not be every year 300. It could be 400, it could be 100, like this. But for the sake of simplicity, I have written like this. Now, please understand that now we are now. Now meaning normally year 0. So, what you have to arrive, the number that 300 you will get in year 5, how much that worth this point in time. We have a mathematical exercise for this. We incorporate something called discounting factor. There is something called DCF or discounting factor. Another mathematical complication. Let's not talk about to arrive the numbers. You have the table. You can use the table. Now, only one simple question. I would like to hear that answer. What is the DCF for year 0? You silent, others please. I'm sure he should know. And what about others? Don't get the help of GPT. As by default, every accountant should know this. How much? Please note that. That is one.
Year 1.
No, year 0. Year 0. Always, year 0 value for DCF is 1. And also, a to the power n. Some mathematical discussion. If I have, let's say, 2 to the power 3, answer is? Yeah, come on.
8.
Huh? 8. 2 to the power 3 is 8. How I got? 2 into 2 into 2. Suppose if I have 2 to the power 0. That exactly, that is here. Because what happens is 1 over 1 plus r over 100 to the power n. And this n becomes 0. Forget about this. This is a different world. We will go to that and discuss. But since I have 0 here, my answer is 1. And for these numbers, you can use the table.
There is a table.
Google, there is something called present value table. Present value table. If you search in Google, you will find it. And then how I get, we need to have 2 information. 1, number of years. 2, the cost of capital or the interest rate. You give the cost of capital 8%, year 2. If you type this in Google, you will get the year 2 discounting factor. So like that, you will find it. Then what you do? You multiply this. And then you will get the answer. And when we do that, you please remember the value in year 1 and the value in year 5, if you compare, what you think which value will be bigger? Year 1 value will be bigger, exactly. Over the years, the discounting factor goes smaller and smallest. So, we take the total of this, and that total is what we call it value in use. Whereas fair value less cost to sell, meaning no, I'm not going to use the table. Bloody table is a trouble. I'm selling this. For me to sell, I need to put a Facebook boost, $5. Or I need to do some expenses. I need to print a flyer or to find a broker, need to pay him or do a transport, whatever. All these expenses I have to pay for, and what is the market value I can get it? So you, let's say, for example, 500 and then I have to pay 75, for example. Market value is 500, expenses 75. So then 425 is my answer. And let's say here it's 400. Then now what you do, you choose higher of both. So what is the highest number now? 425. So your recoverable amount becomes 425. And the carrying amount, let's say 380. No, sorry, 480. Your carrying amount is 480. Now, if you read the impairment now,